Welcome to the deep dive video update. This is a video that I do every week where I look at some charts that are unique just to this video. But the reason for calling this the deep dive video is these are the charts that I'm not looking at all that much. And so we have to look a little bit deeper to see if we're getting any insight from these charts. This is being prepared for Monday, July 8th. Before I get started on this, I do have a thing called the SPX investing program. It launched at the beginning of June. I have early access to the daily video in there. I also do some position ideas and portfolio updates that may be of interest to you. Right now, everything is free, but I will be locking it down soon. For membership, it will end up being $97 a month. If you want to learn more about the program, there are some links below this video and every video that I post that take you to some other videos, a playlist on YouTube where you can watch different videos about the program. And there's also a link that takes you to the website itself if you want to check that out. Additionally, if you want to send me an email, here's an email address. You can ask any questions. We can talk back and forth about that. We could possibly set up a time on Zoom or Skype or Messenger to be able to talk about things just to see if this is something that interests you. Also, I do a number of videos every week. I do a video each day. I do a weekly video, an intermarket analysis video. This video is called the deep dive video. After this, I'll be doing the what to watch video, and I do a series of supplemental videos from time to time. Those are on an as needed basis. Sometimes I get asked the question, well, I've seen one of your videos, but how does that fit into the bigger picture? To me, the big picture is the daily video. All of these other videos are supplemental to the daily video. I have found over the years that looking at things on a day-by-day basis is where you get the best insight as to what's happening in the market. And that not only helps in the short term, but also the intermediate term, long term, and very long term, even if you're managing a portfolio, maybe in an IRA or in some kind of a long-term program that you have, it can still be to your benefit to keep an eye on what's going on, because there are things that I teach in the program that are in the courses that I have that maybe you have a long-term portfolio, but we're getting set to go through a difficult time in the market. There are things that you can do to protect what you already have without exiting your positions. And there's also ways to enhance the returns that you may already be seeing. So that's why I included this graph here, just to show you that I don't just put out one video. I put out a lot of videos. Yes, they're longer. I don't get as many views. I don't have as many subscribers, but the folks that watch the videos tend to get a really good grasp on what's happening, not only in the bigger picture, but also whittled down day by day. The first chart that you see here is the VIX. This measures fear. When the VIX is high, it's time to buy because we've been going down with stocks. When the VIX is low, it's time to go. It's usually we've been going up with the market and we might be hitting some kind of a top. That's the little cliche that we say, but it's a lot more difficult than that. When the VIX was first created, it was created with static numbers in mind, 12 to the downside and 20 to the upside. And those are still important to a degree. But the VIX is more dynamic than that. It can change and have different ranges over a period of time. To do that, I put the VIX on here and then I turn it invisible. And over top of that is a 50-period exponential moving average. And we can see over longer periods of time, this is the general range of the VIX. Now that we've been going up since we ran through a very difficult 2022, and we started coming up in 2023, and so far in 2024, the VIX has been dropping to a lower range. I don't use this to make decisions. This is just something that we want to be aware of. Now, I do pretty in-depth analysis when it comes to the VIX on a day-by-day basis and some other sentiment gauges to see how is the market feeling on a fear and greed scale. This is just one to let us know, okay, we're in a lower range now overall with the VIX. Also, another measurement that sometimes I'll use in the daily videos is how fast is the VIX moving? And to get a momentum measurement from that, I use an RSI based on 9 periods. We look for extreme positive or negative readings. Right now, we're just about in the middle, so there's been no need to show this chart. I really only pull it out when we go above 70 or below 30. We look at the VIX and then we do a ratio with a kind of an indicator of the VIX called the volatility of the VIX, or the VIX of the VIX, if you will. And this ratio typically, in a general sense, when this is going up, that often means that the S&P is going down. When this is going down, that typically means that the S&P is going up. And we are continuing to decline with this overall ratio, and this is looking positive. This is more long term, so I don't use it in the daily videos. We also look at the VIX and then do a correlation with the S&P 500. Sometimes this can give us some insight as well. When we get above this dashed line, this is kind of like the VIX in that the market is getting nervous at that point. We may not be seeing it in the VIX, but we might be seeing it on this chart. There are other times when I've tried to mark where we spiked with this particular correlation, and then what did the S&P do after that? We're not getting an extreme reading right now, so there's been no need to show this chart. Then this is another kind of take on the VIX, where instead of calculating using at the money options, that's what the VIX does. The skew index is calculated by looking at out of the money options. And sometimes when we get up into this red area, the market is expecting some kind of a move. We don't know if it's an upward move or a downward move or just a continuation of what's been happening already. So we have to use other charts to get some more context, but we're not up into this red area. But lately we have been going up. We're getting close, but we're not there yet. We have been there recently in the past, and we spiked and then started to come back down with this skew index. And then you can see what the S&P did at various times. We look at the volatility of bonds. That's measured by the MOVE index. And this has really been coming around a bit here lately, where the volatility of stocks, which is the VIX, this has really been low as bonds have been a bit more volatile these days. What I look at is on the bottom, and we're looking at the correlation between the two, showing the bonds are a lot more volatile these days than stocks, and that's why we're seeing this correlation dropping off. And on a basis of volatility, we're actually seeing them going in opposite directions. We look at the same kind of a measure, the VIX stocks, the MOVE index bonds, and look at a ratio over time. In a general sense, when this is going up, typically that means stocks are going up. But there's other times when this has been going down and stocks have also been going up. So we can't really use this in a one-to-one relationship. What I follow is the red line, which is the moving average. And right now we have been declining overall. We're seeing volatility pretty much across the market start to diminish. Then we look at a risk on, risk off ratio. And I used to show this every day in the video, but lately it just hasn't been all that helpful, pretty much for all of 2024. This looks at high beta stocks, which tend to outperform the market when we're going up. Unfortunately, they also outperform the market when we're going down, meaning they go down faster. And then we compare it with the equal weight S&P 500, which is more conservative and where every stock is treated the same. When this is going up, we tend to favor more of a risk-on approach. That means folks are getting into the big growth stocks. When this is going down, the market is turning more defensive. We haven't really been moving around all that much in 2024. Lately we've been going up as the S&P has been going up as folks are getting a little bit more risk on, but we're not really seeing any massive trends here, so I haven't been showing this chart. We look at that same thing, saying a similar thing with the S&P 500 high beta index, and we compare it with a low beta index. When this is going up, that's more risk on. When this is going down, that's risk off. Since I started using this, we were in a higher range in the earlier part of 2024. Now we've dropped to a lower range, but we're not really seeing any trends developing with this chart. Then just to keep an idea, where are we from the previous all-time high set in early January 2022? We are now 15.53% above that previous all-time high. Then stockcharts.com has this thing called technical alerts, and I go through the daily alerts in the daily video. What you see here are the alerts that were set for the whole week. If they're green or blue, depending on what color you see, they're positive. If they're red, they're negative. We start at the bottom. This was the first signal that was generated back on Monday. And then we can just see, now when I'm looking at this chart, I'm looking for what's most of the colors doing. And we need more analysis to get into see, okay, why is the NYSE showing us a bullish percent index? And then just before that, it was negative, showing the same thing. But we can kind of detect, okay, what's the market feeling? And as a whole, if during a day we see a lot of red or a lot of blue or green. Stockcharts.com also has this ability to try to remove more emotion out of using technical analysis by coming up with a thing called technical scores. You can do this on a stock, you can do it on a sector. I do it on 5 different indexes. The S&P is the foundation of what I do as far as all the strategies and most of the analysis. I look at a lot of different things, but I ultimately evaluate the S&P 500. And this rates them on a score from 0 to 100. The higher the score, the better looking the index that I use here. And I look at the Dow, I look at the S&P, and I look at the QQQs, which is the NASDAQ 100, the mid caps and the small caps. And then I rank them in the next section here with the best chart coming in first place, which continues to be the QQQs, which is the ETF for the NASDAQ 100. Looking pretty strong here. When we get 90 or above, that means technically by removing all the emotion, because even though technical analysis is supposed to remove the emotion for you, there's still a lot of emotion that can be put into technical analysis. This tries to remove even more emotion. And we're coming in at 95.8 right now for the Qs. So this is the strongest looking part of the market right now. In second place, because there are a lot of the QQQ stocks that are also in the S&P 500, it's coming in. It finally got into the 90 territory by setting an all-time high on Friday. And the S&P is represented by the SPY ETF. It's coming in at 90.3. In third place is the Dow. Hasn't set a new all-time high recently. It did a few times in 2024, but it's kind of been languishing lately. It's doing okay. It's just barely above 50, so we would kind of lean more positive with that. But it's coming in with a score of 53.1. And we look at the mid caps, which have been really disappointing lately. Earlier in 2024, the mid caps, when I would do this video, they would come in first place quite often. Well, that's kind of fallen by the wayside, and we're seeing the mid caps really floundering right now, as represented by the MDY ETF, and they come in with a score of 34.3. And in last place this week, which has been in last place for a lot of 2024, is the IWM. This is the Russell 2000 Small Cap ETF, and it's really having a lot of difficulty right now, coming in at 21.5. There are some short-term charts that we look at. I think I only have one here because all the other short-term charts are being used right now in the daily videos. This is a chart that I only use in this video. It's a rainbow, and it's supposed to be longer term. It goes back a number of years. And I plot a 10 through 50 period simple moving average on here. Change the color so it looks kind of cool. But this tells us, based on these shorter term moving averages, what is the short term trend like right now? And we're above all of the lines, and the lines are going up. So this suggests right now, on a trending basis, that the S&P continues to be in a solid uptrend. We also have another intermediate term rainbow going from 50 periods up to 100 periods, seeing pretty much that same thing. As we were pulling back earlier on, the rainbow started to get kind of scrunched up here, but since then we've been coming back up. We're well above all the lines in the rainbow, so the intermediate term trend is still positive. We also look at a 50-period moving average. Now, if we start to see some kind of a decline, I'll be showing this chart a lot. I use the 20-period moving average to define the short term, and we're doing okay, and I'm using that chart every day in the daily videos. If we end up falling below that and start having a more substantial pullback or a decline, then I'll break this chart out and we'll see this as the next possible level of support. But we're well above that, and all the lines are going up right now. And I plot both a simple and exponential moving average on here. That's why you see a blue line and a red line. The blue line is an exponential moving average, and it moves faster. It's weighted closer to more current prices, where a simple moving average, and that's what most folks end up using, where it treats all 50 periods the same. This can be helpful just looking at this, showing when the blue line is above the red line, that just means there's more conviction behind the move. We do the same thing with the 100 period moving average, because if we fall below the 50, the next level of support, based on what I do, is going to be at the 100 period moving averages. This also shows the green line, that's the simple moving average, is actually above the red line. So we're not seeing as much strength there, but the fact that price is above both of these lines and they're going up, that is positive in and of itself. We have another oscillator that I use as a extreme positive or negative oscillator called the Connors RSI, where we just look at this when we go above this black line to the top. That means we're extreme positive, or we come down and look extreme negative. We chop all around on a day in and day out basis, but we don't get extreme readings all that often. So I haven't been showing this chart. This is a point and figure chart. This measures either buying or selling or upward moves versus downward moves, and it takes time out of the equation. It says, okay, when the S&P moves up by a certain amount, an X is drawn. When it moves down by a certain amount, an O is drawn. And it doesn't matter how long it took for that to actually happen. This is looking positive right now. We're still working off of these X's here, and we're working off of a signal that was triggered back on May 15th, which was a double top breakout. But there weren't any new X's or O's drawn this past week, so I haven't been showing this. Even though we're setting all-time highs with the S&P, we still have to go up a little bit further, if we, in fact, even do that, to generate another X. Then this is an anchored moving average. Now, we use regular moving averages, which take the current price and then go back however many periods are in that particular moving average. Let's say it's a 10 period moving average. It takes all those 10 periods with a simple moving average, adds them all up, and then divides by 10 to get an average price. And then the next day, the new day is added and day number one falls off, but it always just goes back and calculates 10 periods. An alternative to that is called an anchored moving average. And these can be quite helpful, especially when we're declining, because this is going back to the previous all-time high and then going forward here. And that's where it's more helpful. Where a moving average itself looks back, the anchored moving average projects out as to what it thinks will happen. Now, I haven't added a lot of additional anchored moving averages on here because we keep going up with the S&P. If we start to see a decline, I'll probably find some of these significant tops, add more anchored moving averages to this, and see if they end up providing support. There's also a couple of anchored moving averages here going back to the COVID low that was set back in 2020, and we're still well above those levels as well. Then this is more for information. This shows that we're above the 200-day simple moving average. And as of Friday's close, we are 13.91% above the 200-day simple moving average. Standard deviation, for a while I was showing this. I usually don't show this chart when we're below this blue line, which is a moving average. This goes back over the last 10 periods. It's not measuring direction, it's measuring speed. How are we deviating away from the mean, basically? And we were spending quite a bit of time chopping sideways, and that's when the standard deviation really started to drop. Now that we're going back up and breaking out of that range, we're seeing a pickup, but we're still below the moving average. If we get back above the moving average with this indicator, then I'll probably start showing it again in the daily videos. On top on this chart is the S&P 500, which set an all-time high on Friday, and the S&P 100, which is outperforming the S&P based on other videos that I post. And they're pretty much confirming each other right now. Where we take note of this is if we're seeing the S&P 100 really going up and the S&P 500, now it will probably lag because there are more stocks, or the 100, those are the bigger stocks that have really been moving. We're trying to find some kind of divergence here. Right now, we're seeing more of a convergence in this chart. Then this is a measurement going back to the October low that we set. And then how far are we up since that time? We're up 26.2% from the October 2023 low. Again, more just for information on this chart. This is the mass index, which is not generating a signal right now. We really pay attention to this when we get up to the red dashed line and the blue line. Since we're far away, there's no single signal that we're seeing now. This is the Ichimoku cloud, which is really just a series of moving averages that are then shifted forward. A lot of people use these, and I use these more as support or resistance. You can see where we have a green cloud and then it kind of went flat, turned a little bit red. Now we're turning back to green again. When we're above this cloud, I don't show this chart because we're far away from it. What's going to happen is if we start to pull back and come down to the cloud, you can see when we had the difficult time back in April, we came down into this cloud and this area ended up holding as support. If we fall back and come into the cloud, we'll be watching this chart again as well. Then this is also an Ichimoku cloud, shorter time frame, but there's more studies on here. We're actually looking more at the trend. The blue line is above the red line, and that is more positive. You can see when we're really going up, that just shows that we're in a positive trend. If we start to decline and the blue line drops below the red line, that'll turn things more negative. Then we also have another green line right here, which is also continuing to go up. This is suggesting that based on the Ichimoku cloud full study, we are in a time, based on all different time frames that it measures, we are in a pretty solid uptrend. Then I have another long-term rainbow chart going from 50 periods up to 250 periods. This is also suggesting that the long-term trend continues to be positive. Then this kind of comes and goes. I haven't used it in a while now. This is a 10-day average of the S&P 500 highs minus the lows. A little bit longer term, but I use this more like a momentum indicator. When we're really going up and we get above this green line, which is the 90 level, that's quite positive for the S&P. That means that over 90% of the stocks in the S&P 500 are generating more new highs than new lows, and we can stay camped out here for a long period of time when we're really moving up in a solid fashion. Well, we dropped down when we hit those problems back in April. We're starting to come back up, but we're not quite above this 90 level, at least yet. That will be more positive if we can get up here and then stay here for a while. Now, there's other times when we look at this like an oscillator, especially back in 2022, when we were really going down, you notice we didn't stay here for very long. That was like a counter trend bounce. And so then we say, uh-oh, we're looking overbought. We're looking to reverse at this point. Well, now that we're in a solid uptrend, we can stay up here for a long period of time. If we do get to the point where we see a significant decline, we'll probably end up using this as an oscillator if the bigger picture long-term trend is still intact at that point. This is a long-term oscillator called the Special K. It continues to be positive. Unfortunately, the weekly chart still continues to be negative. We don't see a lot of crosses here above this red line, so there's been no need to show this chart. I really, for now anyway, have been just showing it in this video. This is a weekly chart of the S&P on top, a weekly chart of the German DAX. That's the biggest stock in the EU, or biggest market in the EU. And they've been bouncing around. There's been some upheaval concerning the French election. UK just had an election where the US market has been holding up a little bit better. And so we're seeing that correlation really starting to drop off. Sometimes we can see that Europe and the US are more going in tandem with each other, and that's not quite happening right now. Once we get beyond all this election stuff, barring any kind of other geopolitical event, we might be likely to see, or we might end up seeing, where the correlation ends up becoming stronger. Now, it's not measuring direction. It just means they're going in the same direction at the same time. Then some support and resistance. This is also looking at the short term, where we take a 20-period simple moving average of the open, the high, the low, and the close, and it comes up with its own little mini rainbow here. And we're above all the lines in the rainbow. And sometimes when we're going up and we fall back down, one of these lines may end up acting as support and then we bounce up. If we're starting to go down, one of these lines may act as resistance if we're starting to bounce back up. When we break through from the underside of the rainbow to the upper side, that's when things have a tendency to shift back and look more positive. And we're looking pretty solid here. We're far away from the mini rainbow, so I haven't been showing this chart. Then these are the possible fib retracements. We haven't had really any kind of a significant pullback since April, and we just keep setting new highs with the S&P, so I keep adjusting this. We'll be watching this 38.2% retracement level if we start to see a more substantial decline. A broad market measure, I was also showing this back in April and into May when the shorter term moving average for the QQQs was falling below the 50-period moving average. The blue line is a 20-period moving average. And that was giving us a little bit of a concern as we were seeing weakness in the short term. We were able to come back up and see the blue line cross above the red line, and we've been well above all of the plotted moving averages here. This other darker blue line is a 200-period moving average. So this is just showing that the NASDAQ 100 is still in a solid uptrend. Then we look at the, excuse me, we look at a thing called the Vixen, which measures the volatility of the NASDAQ 100. That's the counterpart to the VIX, which measures the volatility of the S&P 500. I don't use this an awful lot because you can see some of these bars look like icicles falling off a roof here. I look at mostly the line. That's the closing value on the bottom. And we're seeing a bit of a pickup here, but we're still below the moving average as the NASDAQ 100 continues to set new all-time highs. And that tends to make the Vixen go down. And you got to love that name. This is the bank ETF. We do keep an eye on the financial sector. And we also look further at the bank ETF, because this is what led to things back in the great financial crisis, was a real problem in the banks. And so we just kind of like to keep an eye on this whole thing. Right now, the bank ETF, it's not doing all that great. It's in an uptrend, but it's been chopping sideways for most of 2024. But the blue line is still above the red line, showing that we continue to be in that uptrend. This is also what we're keeping an eye on, the regional banking ETF, and that includes Republic Bank, Silicon Valley Bank, New York Community Bank, banks that have reported having problems over the last year or so. And then we do a ratio to the financial sector. And this is what things were looking like before Silicon Valley Bank came out. Then we saw a real breakdown in this ratio, and then it just kept going down, down, down. It finally started to look to improve, and we were getting close to actually setting an uptrend. And then New York Community Bank came out, and they said they were having problems, and we ended up starting to fall down below this again and turning negative. This is just an area we want to keep an eye on. Seems to be holding up okay for right now, but we always want to keep it in the back of our mind that if the banks start running into problems, because they've anticipated interest rates being cut in 2024, and as of this video, first week of July 2024, that hasn't happened yet. Is that going to impact especially the regional banks? Then we look at a ratio between the Qs and the Dow. And this is just showing that the Qs are outperforming the Dow. And we compare it with the S&P 500. We take a correlation between that, showing that they're tending to go in the same direction at the same time. The transports have been a real disappointment in 2024, where the Dow has been going up. It's not setting all-time highs right now, but it's in an uptrend where the red line, these are the transports, and they have been really lagging behind. Then we look at the S&P as represented by the SPY ETF, and that's setting new all-time highs. And then we do a ratio between U.S. stocks and world stocks, showing that U.S. stocks continue to outperform. These are just for informational purposes. I go back 250 periods with a rate of change chart. So the close on Friday, and then it goes back 250 periods and says, okay, are we higher or lower from 250 periods ago? And we're not really breaking out right now, but we're holding up with this particular chart. And then I go back much longer. I go back to 1980 here. And this is still showing that overall, we're looking pretty solid. We kind of bottomed in late October 2022, and we've been going up since that time. We get a little bit nervous if we come up above this blue line. Doesn't mean we stop here, but sometimes there have been times when we're starting to get a little extreme, but we're not really getting to that line, at least yet. And we keep an eye on bonds. Now, I show a lot of bonds, and I do a lot of ratios between different ways of looking at stocks and bonds together. This is one of the charts. I don't show it that much because the movement in this chart is not all that pronounced. There's a thing called TIPS, which are Treasury Inflation Protected Securities. They adjust for inflation, and typically they're shorter term. When folks are worried about inflation going up and interest rates going up, they get into TIPS. When they're not as worried about inflation and interest rates start to come down, then they get into 3 to 7 year bonds. And this is a ratio between the two. So the TIPS were outperforming in 2021. And then we saw things start to calm down a little bit in 2022, and we actually got to the point where we were seeing a downtrend. Unfortunately, we've been seeing tips starting to go back up here. It's more pronounced. I also have a 7 to 10 year ratio that I do with the tips. You can see the movement a lot more in that chart. This is starting to go up, meaning are there inflation worries that we need to be concerned about? The market would be telling us yes, but they're not really all that drastic at this time. Then we look at the long-term bond ETF as represented by the TLT. That's the blue line. And then we look at the S&P 500, which is in red. We look at a long-term correlation where it's fairly strong, meaning the long-term bond and stocks are tending to go in the same direction. But the short-term correlation, they're actually having a tendency to go in the opposite direction. We do that same basic thing with the QQQs, and we look at a ratio with the TLT, again, the long-term bond ETF. It had been showing a really strong correlated relationship. Now it's starting to back off just a little bit. Then we have a chart up here with the 10-year yield, and we subtract the German 10-year yield. Because US rates are higher, that's why we get an answer above zero. And then for some reason, and because you have the interplay between interest rates and the US dollar, then we plot the US dollar index down here, and we see that there's a pretty strong correlation between the top chart and the middle chart. So if this is going down, that can put some pressure on the US dollar index. If this is going up, that may give some support to the US dollar index. We keep an eye on the yield curve, which is, it's been over 2 years now since the 10 to the 2 year has been inverted. It's been about a year and a half. Well, we're coming up to almost 2 years with the 10 to the 3 month. And this is not normal. Typically, the shorter term rates are lower than the longer term rates. When they're not, that means we've gone inverted here, and we're just keeping an eye on this to see if that will end up changing soon. Then I have a number of things called possible positive scenarios. These were very helpful back in 2022 when we were really bouncing down, and then we would see a counter bounce out of that. And those charts can really help us when we're trying to establish some kind of a bottom and then possibly bounce up from there. Well, I use a lot of those charts every day in the daily video, but there's some charts that I haven't been showing all that much, like this chart. Now I have another study based on the 200 period moving average of those stocks inside the S&P, and we're just measuring up and down that way. This one is built more like an oscillator. When we get an extreme positive or negative reading, not seeing that right now. And when we're above 50, that means we're more positive. Even though this has been coming down, we're still above 50. We do that same basic approach with stocks above their 50 period moving average with the S&P. Also, sometimes using this as an oscillator, and we're actually dropping below 50 here, and that's slightly negative. We look at the mid caps using it like an oscillator, and it's actually dropping a little bit below 50 even more. So they're showing some weakness. And we're even seeing a little bit of additional weakness here with these small caps with those stocks above their 50-day moving average. We look at the 2-year yield because sometimes when this spikes and starts to come down, that can give some good support to the S&P. We are coming down a little bit right now, so that may be where we're getting a little bit of the thrust from these days, but we're not seeing any real pronounced movements at the current time. So thank you. I hope you found this helpful. I hope you're having a really good weekend, and I will talk to you in the next video.